Okay, we are back for episode 25 of the Corporate Real Estate Insider podcast. We all had a nice Thanksgiving, and we are excited to be recording another episode here just after the break. Brian, let's start with you. I know you have an interesting story and conversation that tenants all around the country are having with their landlords. Let's go.
Thanks, Tucker. Yeah, it's pretty interesting. So we've been talking a lot about how landlords are in a difficult position, but let's flip it to the landlords that are well positioned, the ones that don't have debt issues, but do have lease-up issues. And what we're seeing, and this is a particular situation that I can describe, but what we're seeing is a well-capitalized landlord that owns the building for a long time and has about 50% vacancy in the building. So what they're doing is they're initiating a construction project to upgrade the building. So they're upgrading windows, they're upgrading the lobby, they're upgrading the fitness center. All great things for tenants, right? But if you're one of and this is where it gets to be something that's going to be happening nationally, if you're one of those existing tenants in the building, you're going to have to live through potentially years of construction. Your lobby's going to be shut down, your fitness center is going to be shut down, your cafeteria is going to be shut down. And what is your recourse, right? Usually nothing if the lease is not very specific around that. But what can you do, and how can you mitigate the disruption to the tenant? So, in this particular case, the answer is really nothing. You have to live with it, and it's one of the I think the downsides of being a tenant today with landlords that are going to need to reinvent themselves and really reinvent their buildings to be able to attract new tenants. And who's going to suffer is the tenants that are stuck in place, usually at higher rents because the market they transacted in was higher, and also just living with a construction site for a long time.
Yeah, it's also true for the buildings that have now traded at some steep discount to prior pricing, 30 cents on the dollar in San Francisco, some examples. And so suddenly those landlords are in a position to reinvest in the asset to make it competitive. So you bring up a really good point. I'll add one other wrinkle to that to keep in mind is, when is that expense occurring? Imagine you go into the building in anticipation of all that. But if that occurs the second year of the lease, that's not in your base year. That's a pretty significant capital investment. You're going to be, the tenants in the building are going to be footing a significant portion of that if it's not in the base year.
I think that's very important to look at. So some of those improvements certain ones can be passed through, usually over the useful life of the improvement on the capital side, right? So you have to watch out for that. And that's if your lease is structured properly and the improvements are done in a way that adds value or reduces cost, that's a standard in the lease that's probably not going away. But the certain other ones, like lobby improvements that are above a standard for what you signed up for, could cost significantly more than what you anticipated, and they may not be something that you should pay for because they're to attract new tenants. Even though it's something that you're going to utilize, it wouldn't have been done unless there's significant vacancy in the building. So there's going to be a push-pull there, and something certainly companies need to take a look at in their operating expenses on an annual basis.
So can I ask a question? Do you all, this is a little bit of a rabbit hole, but it's worth going down, this concept of maintenance, repair, and replacement, where I'm constantly saying, look, we shouldn't be paying to replace the building elements. That's what we pay you rent on, is a building today. If we're both paying you rent on the building today and allowing you to pass through the cost of replacing the building, aren't we paying for the building twice? And yet it's fairly common to see repair and replacement included as an operating expense. I try and fight it.
Yeah, I mean, you got to look at it two ways, John, because sometimes it's less expensive to pay for the replacement of an asset and the annual depreciation of that asset over the useful life than it is for the landlord to repair it. So think about an HVAC unit that's 20 years old that's costing 2, 3, 4x what the depreciation of the useful life cost would be on a capital basis. So I've run into situations where we've had to force landlords, because if you have a building that's 50% occupied, they're not going to pass through the total cost. It's only your pro rata share. They're going to eat the vacancy because the tenant that's not in the building yet is not going to be charged back for improvements that were done to attract them to the building. So what we're going to start seeing is landlords not doing capital repairs. They're going to start to try capital replacements. They're going to try to repair everything because they don't want to carry the vacancy side. The other thing that they're doing is they're trying to use as the denominator as the occupied space for the depreciation of the improvements rather than the total size of the building. I've seen that in a number of leases lately, and it's like, time out, guys. It's based on the size of the asset, not based on the size of the occupied space within the asset at the time, or in general at the time that you're doing the improvement. So those are things you have to watch. Landlords are trying to shrink the denominator to try to get a higher return or recovery on those improvements. But especially with, like, in New England right now, in Boston, there's energy code. There's a stretch code that's requiring landlords to do significant capital improvements to the HVAC system. That is going to be a difficult one because you may have a fully functioning, highly efficient system that, if the landlord has to replace it because they're trying to get tax credits or they're trying to fill vacancy in a building to get permitting, then you're replacing something that isn't at the end of its useful life. And how do you recover that? And those conversations, I think, are still TBD.
This is super important, right? And if you are a tenant that's in a largely vacant building and you still have remaining lease term left, you have to be super aware that landlords are going to be trying to take advantage of the situation, right? They may say, hey, you know what? This is a perfect opportunity where this tenant can't leave. They have to deal with the construction. I'm just going to improve my building for the duration. At the same time, if you're a tenant in a building and you're approaching the end of your lease term and it doesn't seem likely that you're going to stay, the landlord may be trying to pass through all types of capital that they possibly can so the building's in a much better position for them to lease it when you ultimately leave or downsize or whatever you may be doing. I think it's really important when you're negotiating a lease to make sure that when you're dealing with the majority of these mechanical, electrical, plumbing, like major building systems, capital expenditures, things like that, you want to make sure that when you're signing the lease that the landlord is providing some kind of warranty that those major building systems have a remaining useful life that is at least equal to the initial lease term. And that if they do not, or for some reason, that's not due to tenant's negligence, those systems no longer work, that it's landlord's sole expense to fix. And that could be replacing, it could be repairing, it could be a combination depending on, what systems are at play. And that is generally the market norm to get landlords to agree to that. Of course, it can become more challenging. I mean, I would say that the only time that we're not consistently getting those are when we're dealing with a non-institutional one-off owner, usually in an industrial setting, and there's a lot of competition for the building, and they're like, whoa, I'm just a passive real estate owner. I won't take this risk. This needs to be the tenant's risk. And I think that that's stupid and sort of a BS response, but they're able to lease their buildings anyways, because if you're a 10,000 foot plumbing parts wholesaler or something, and you might just not have sophisticated real estate people helping you mitigate this risk.
Yeah, now that we're down this rabbit hole, I'm going to go one step further because I think this is super important. Brian, you bring up changing the denominator in passing through the capital costs of capital improvements. That effectively puts the burden of vacancy on the tenant, not the landlord, which is crazy. The landlord gets all the upside from their real estate investing and, of course, bears the burden of vacancy. It's up to them to get the place leased out. So there's one other example of that. I don't know who needs to hear this, but I've come across it a couple times recently with a gross up provision in a triple net lease. Like, no. Let's not be grossing up triple net leases. And I've even heard the argument in favor of it, like to maintain services during vacancy. Again, that's the burden on the landlord of having vacancy. You can't shift that burden of vacancy onto the tenant. And I don't believe that there should ever be a gross up of a triple net lease so that the landlord ends up passing through expenses they didn't actually incur. That's just crazy. So let the world hear it. No gross up on triple net lease.
But I think what he's saying is they want to take a cost and they want to gross that cost up as if fictitiously the building was fully occupied, right? So they're taking the actual cost of a building, which you are absolutely required to pay your pro rata share of, grossing that cost up as if it was fully occupied, and then charging you a pro rata share of a fictitious number in the event the building was fully occupied. Your cost is a pro rata. Yeah, your cost is
for variable expenses.
For variable expenses. Your cost is the actual cost. Like if it costs something, you pay your share of it. You shouldn't have to pay for a number for a tenant that doesn't exist. Just they're trying to burden the tenants with the cost of carry. That's all they're doing is trying to get you to carry a space that doesn't have a tenant in it.
For the listeners here, I mean, think about this. Think about you moving into a building where it's 50% vacant. You know, that, and if what John is talking about, Tucker, I think what he's trying to get to is if there is a gross up provision, the landlord can then, for our listeners here that don't understand gross up provisions, can estimate what that variable expense might be if the building had been fully occupied, but it's not. And so I think what John is suggesting, if it's a triple net lease and there's a gross up provision, the building's 50% vacant, landlord's grossing it up as if it wasn't vacant. Now you're paying expenses on space that is sitting dark. There's literally nobody there. There's no lights on. There's no HVAC running. It is literally dark shell space, so to speak. And so landlord, it's a profit center. I mean, really, is what it comes down to, I think. And maybe I'm misunderstanding John's point or Tucker, yours point, but that's what I see what's going on.
Yeah, you're paying expense on an expense that didn't occur. And I mean, it's just lunacy. And so I would love, we'll get a landlord to come on the pod and we'll debate the topic. Maybe I'm missing something, but no, I don't think we should ever allow a gross up under a triple net lease. Pretty clear to me. Okay, so now I need to clarify one more thing. We may decide this is all way too wonky. The purpose of a gross up provision, in my opinion, is in a base year comparison methodology for operating expenses, where the landlord is going to cover all the expenses, including the variable expenses in the base year. The tenant is going to be responsible for those expenses as they increase over time over the base year amount. It used to be called an expense stop amount, and they would literally give you the dollar amount. So I can't think of a better way other than the base year comparison, the grossing up for the base year, to then allow gross up in the base year and gross up in every subsequent year so that we're comparing apples to apples. I believe the purpose of a gross up is to ensure that there's a fair base year amount, which becomes the basis on which all future expense increases will be based. I think that's the whole purpose of a gross up, and I think sneaking it into a triple net lease is taking a familiar concept and applying it where it doesn't belong.
To get back to what my original point was, though, landlords are going to start to try to do this in a lot of different ways. And I think construction of their buildings, right? So one thing that they'll want to do is energy codes change. These older buildings that need to be reinvented, the exterior windows are probably not meeting current energy code. So if they go to try to do a lobby renovation, or I think even if they try to do major tenant renovations, it could trigger a code review of the energy codes for the building, right? So usually those are based on cost thresholds of a construction project within the building. So it could trigger them to have to do upgrades to the base building, including the exterior windows of the building. So in the example of the tenant I was talking to this morning, landlords do rewrapping the building with new windows. Their space at one point didn't have windows. Do they get a rent abatement or not, right? Can they use the space with boarded up, and then at certain times the board's coming off and them installing new windows during the workday, right? So how do you deal with that? One, how do you partner with your landlord if you have a critical business within that building? Thankfully, this is office space, but what if you had, in certain situations, tenants have office and labs. They have either electronics labs or even more advanced labs in office buildings or in flex office buildings. How do you deal with that potential disruptions of your operation, and how do you mitigate the cost? Because maybe a rent abatement means nothing to you if your business and the value of your business is critical and you need to be there. So those are, as you look at your leases and start to negotiate leases, I think, the average broker right now is like, oh, we need to get financials from our landlords. We need to make sure we have an SNDA. Well, a more advanced broker and someone who's been through real estate cycles is going to start to dig into tax and operating expenses and start to really understand how they're operating the building and how the lease is structured to make sure that you're not put in a position that is a disadvantage to you if something changes. The other one is these capital improvements and how landlords can go about, they sneak these in. There's stuff where the lease allows landlords to do improvements if it is to the benefit of the tenant, right? If the energy costs are going down, that's a benefit to the tenant. They're allowed to do that. Well, it's very disruptive, and it's very costly. So do tenants really want to be required to pay for those types of improvements, or are they just not predicting those costs? You just having visibility is the most important part. So I think you really need, brokers are really important right now in terms of how we dig into all of the what ifs in leasing, especially in a market like it is today.
Brian, earlier today you were telling us a little bit about an active deal that you're working on. Client in a sublease wants to add term on the back end. This is a conversation that people are having all around the country, right? You find a really competitive, attractive sublease. It might have 2 or 3 years of term left. You might have a company saying, that's not enough time. I don't want to be in a position where I don't have certainty to stay beyond that initial sublease period. I'm going to go try and do a direct deal with the landlord on the back end. I think our listeners would love to hear about that experience and any recommendations you have for effectuating those kinds of transactions.
Yeah, thanks, Tucker. It's a really interesting, and you summed it up very well, a really interesting situation, right? So we've approached the owner ahead of completing the sublease saying, what would you propose for an extension beyond a 2027 expiration on the sublease. So the sublease rent, and this is a Class A building, is roughly $40 a square foot, as is furniture and everything in place. And this is a large deal, a couple hundred people, so it's a material size deal for the building. We go to the landlord, and their initial offer is $80 a foot for a 2027 start for a 3-year extension beyond the sublease term. The rents that they're proposing, and that's an as-is $80 a foot. So the rents they're proposing, if you look at it on a net return basis to the owner, is effectively the same pro forma that they would have offered prior to COVID and prior to the current environment we're working in today. The challenge is that this is a space that's fully built out. There's probably $300 a foot in CapEx that we're avoiding because we're getting furniture, we're getting a fully built building. There's some minor modifications, but we're in a position where this space makes a lot of sense to us, and the landlord is really trying to take advantage of that. If this was a new tenant market deal, they would never move into a space at $80 a square foot. So on one side, the CFO is saying, we need cost security, right? We need lease term to amortize our own equipment and just the build that we're putting into the space. 3 years is a very short amortization period for our CapEx. Even as low as it is, it's still very short. We have no cost security beyond the 3-year sublease term because we don't have renewal options and we have no mechanism to remain in the space. So is it better for us, the question we were asked, is it better for us to just wait and roll the dice, or is it better for us to play ball at the landlord's number, even though we know it's above market, because our sublease allows us to blend it together? So an 80 and a 40 is a $60 blend over, say, 6 years versus, a 40 and maybe that 80 becomes 70. But it also could become 90 if market conditions change. And this is a real difficult situation, and there is no right answer. But it's one where I think what we're doing, and we're doing it this morning. I have one of my partners out. We're going to some direct landlords, and we're going to look at a competitive piece of space that is built today but doesn't have plug-and-play sublease, and we're going to try to negotiate a direct deal in this environment on a long-term basis. And we're going to compare that deal to a blended sublease where we have no leverage. So we're trying to front-load the leverage for direct vacancy today and see if we can get a particular landlord to play ball. And that combined deal with a landlord, how does that stack up to doing a sublease with a wrap on the back end with a landlord who thinks he has a captive tenant? And I think that's the strategy that we're going to undertake, because it's really our only option given the situation.
Yeah, I think when you say there's no right answer, really there's no right answer because there's incomplete information. If we knew exactly what was going to happen with the market, then it would be very easy to decide on a company by company basis what each person should do. And for these larger, more established companies that look at a 3-year sublease that's fully furnished, move-in ready, has no capital costs of moving in, they look at the 3-year term as a detriment and not a benefit, right? They're in this interesting situation of what do you do? Because it's no guarantee that you're going to be a captive tenant at the end of 3 years, right? I mean, if you had done this before and you're coming off of a 3-year sublease right now, no landlord is going to think you're a captive tenant. They're going to think these people might relocate, go to a really affordable sublease that may also be fully furnished and require no CapEx. It's just a matter of what's the sublease inventory going to look like in 2026, 2027, right? I mean, in many markets, we've already seen the amount of sublease space coming down, even though the market's struggling. And it's not as if that space is necessarily being subleased or leased. The master leases are just expiring, and now it's no longer available as a sublease. And foolishly, many of these landlords are still requiring tenants to move their furniture, remove their cabling, and creating an environment that's no longer plug and play. So it is really interesting to think about and try and sort of craft some sort of hypothesis for each individual client of what's going to make the most sense for you. If only we had a crystal ball and knew exactly what all of these different factors were going to be 3 years from now.
It also sounds like a little bit of a transactional mismatch. I mean, you don't often see the large, long-term, stable, largest companies playing in the sublease space for that reason. When Apple keeps expanding here in San Diego, they're not jumping around and doing all these little subleases. They're making big, bold moves, and they're signing long-term direct leases. If your group is worried about the amortization period for that capital expense, it just feels like they fit in a direct lease with a landlord. Hard for them to play in that little nimble, discounted sublease game.
Totally agree for many large companies, but I would tell you some of my largest clients, given that it's $300, one of them it's up to $500 a foot, they don't think it is prudent, both from a cost perspective, and from an environmental perspective, not to consider space where they don't have to gut it or it's been gutted and rebuild it. It's a real big deal now from an environmental sustainability perspective to take space that's already built. It's 50 to 70% less impactful from an environmental perspective to take space that's been built than it is to build new space or gut space and pull it. So there's bigger issues at play, and they want to look, and we're going to go look at doing a direct deal, right? But they want to say, look, we're not going to walk away because it's complicated or it's challenging. We want to try to utilize what's there. Then we can celebrate that we're moving into space that someone else built, and we're not spending all this money on the CFO side, but also spending all this, making this environmental impact to go build space in a market where there's lots of space that's built. So that's the drivers behind it, which I thought was, I think it's unique in terms of my whole career in thinking that way. Because you're right, John. In the past, they make large strategic moves and they do it their way, and the big companies just, this is what we do, this is how we do it, and get out of our way. But I feel like that's changing today.
That's good to hear. Great company.
Yeah, guys, the challenge, though, with this, Tucker talked about subleases going away because some are expiring. The other thing that I'm seeing across the country, for that matter, is the good stuff is leasing. When you bring these high-quality subleases to the market that are beautifully built out, more often than not furnished, and to Brian, your comment, someone spent $500 a square foot, whether you're doing a direct deal or a sublease, those are the spaces that are actually moving right now. I see the stuff that's like second generation kind of commodity office space, if you will. That's the stuff that just lingers, sits, doesn't lease, then goes back to the landlord. And then the landlord, maybe robs furniture from it to go furnish some other space, and it just kind of becomes now vacancy. But it's interesting because you look at a sublease market. I have a client right now that I'm helping move into a sublease that's probably one of the nicest subleases in Seattle, and it was actually somewhat challenging to find something that was so spectacular to that which we are going to be subleasing, and to that sub landlord's benefit, they've had quite a bit of success with disposing some of their space. But all of the other spaces out there, for the most part, wasn't even close to being on par. Now, granted, my client has very high standards, so we're looking at Class A plus premium space. But it's just funny when you survey the market, and my clients from the East Coast, and they're just like, wait a second, I'm seeing a third of all office space in Seattle is available either on a direct or a sublet basis. Yet you're telling me that there's only this many options? And I'm like, well, based on your taste, yes, right? You're looking for $500 square foot space with FF&E that probably costs another $50 on top of that. So FF&E being furniture, fixtures, and equipment, of course. Interesting world right now. So,
hey, Owen, how big is that requirement approximately?
35,000 square feet.
Okay. One of the interesting things that I found is I think that in many markets, there's disproportionately less attractive furnished move-in ready spaces that are smaller than larger, right? And you think about the mechanics of that. Why has this happened? And the average lease duration that a 3,000 or 5,000 or 10,000 square foot tenant is very different than a company that's signing for 100 or 200 or 500,000 square feet. Most of those leases are much longer term. And if those tenants are subleasing, they generally still have meaningful years left on the master lease. Not only that, I think that for a lot of these smaller companies, if you're in 3,000, 5,000 square feet, it was very binary of, hey, we either sublease the whole space and leave, or we sublease none of it and stay. And for a lot of these larger companies, I mean, you think if you're a high-rise tenant, just to make it a really easy example, and you're in 20 floors of space and you only need 15, well, it's really easy to just sublease 5 of those floors. So I find that the larger your requirement is, without going over probably 100,000 feet, maybe even 50,000 square feet, that the sweet spot for getting really high quality space, particularly if you're more of a creative user, it's not 250,000 square feet and it's not 5,000 square feet. It's more like 30 to 50, maybe even 60, 70,000 square feet in most of these markets where the best sublease options still exist. You think of companies like OpenAI just signing this 400,000 square foot sublease in the San Francisco area, right? In a matter of 5 years, the company who they subleased from Uber's just going to have right-sized the real estate and not be carrying a sublease anymore. So in time, these subleases aren't going to exist. Those opportunities are going to be gone. And you're just going to be looking at which of these direct spaces do I lease. And I think that's going to be really challenging for a lot of these companies, just given the cost to construct space and the cost to buy furniture.
Absolutely. And the other piece of, and I think you make great points, Tucker. The other piece of this is, and I'm dealing this with a client right now who made a brilliant move as they're contemplating the design of their space to take a 200,000 foot design and put it on hold and work with the business units to redesign it where each individual floor can stand on their own. Because what the challenge is in these larger requirements is that it's designed as an envelope where they put and they force amenity spaces and spaces that attract groups of people away from their desks together. And they put them in particular clusters, either on an amenity floor or an amenity area on a floor, which creates space on the other floors that really is difficult to stand on their own. So as you go look at, Uber has 400,000 feet, you want to take a floor of that or 2 floors of that, you will go into that space. And I see this with Microsoft space in some markets that I've toured fairly recently. It's not great space, even though their build out is very high end. What you're looking at is their commodity space that's not amenitized, that's not, because it's only a piece of this larger envelope that provides the overall experience for their people very differently than if you peeled away a floor or two. So my client made a brilliant decision to redesign this building. So if they did decide to make a change, each floor could be leased independently and would have the design to support a company on its own, which I don't think, by and large, is something that the industry has done overall.
Well, hey, that's been a good discussion. Let's switch gears here. I got some news I want to share with people. It's consistent with some of our previous conversations. I think on an earlier podcast, maybe it was like podcast, 4 or 5, I talked about the federal government having just returned from a trip back then from DC, and how much space was available and how gutted downtown DC seemed to be during lunch hour. Like nobody was down there. Well, last week it was reported that if you think your company or companies are struggling to fill office space, you got to just take a look at the federal government. It's quite astonishing, but they are actually, their success in getting people to come back to work is the lowest across the country, worse than, say even the technology companies that have really embraced hybrid work. What's shocking is that this is, we're talking 270,000 workers that work at federal agencies that just don't go to the office. And what's disappointing for me as a taxpayer, and I don't want to make this political, but we spend $2 billion a year, $2 billion, operating buildings that our government owns. These are office buildings, okay? We spend an additional $5 billion leasing office space from private investors. So think about that, folks. That's $7 billion we're spending a year on office space that largely is unoccupied. And so, maybe the fact that majority of that spend goes to spaces that we lease, if people are never going to come back to work, well, let's hopefully that, we make smart decisions and let those leases expire. But it's whatever the normal becomes, we certainly need to right-size that spend because it's pretty astronomical, if you ask me. And it was funny, I went into this article, by the way, if you want to read it, it's in the Wall Street Journal, but I went in and dug in a little bit further, and it turns out that cities, are having more success getting their people to come back to work. I'm talking about city employees than our own federal government. And the article suggests that the reason being is that the mayors realize how critical office occupancy is, even if it's on a limited basis, to having a vibrant, safe downtown, as well as increasing the tax basis. And so and I completely agree with that, by the way. I work in downtown Seattle, and we've had our fair share of challenges, both in terms of getting people back to work in the city and then also just public safety and vibrancy of a downtown. And I've been, constantly saying that in order to support all these retailers that really, in some respects, define these commercial office buildings, because as someone who's not in the industry, if you were to say, hey, what building do you work in downtown? Odds are the person who's giving you that answer probably, says, oh, it's the building with such and such a restaurant on the ground floor or some store, right? I mean, in my world, we all know addresses, building names, et cetera. But for the average person, buildings are often defined by the retail. And when you don't have people there from 9 to 5, 8 to 5, 8 to 6, whatever it might be, even on a hybrid schedule, 3 days a week, why would a retailer open up a store downtown? There's no revenue to support that. And I was talking to some landlords over the past month or so saying, hey, you really got to activate your building. You've got to get these vacant retail spaces filled because it just feels like a ghost town when you're coming in. Offer the space, on a percentage rent deal, meaning that, your goals are aligned with the tenant. If they don't make any sales, they don't pay any rent. And remarkably, I had a couple landlords tell me, Owen, we're offering the space for free, literally for free, just to get the space activated. And they still can't get people to come downtown to open up a coffee shop or a sandwich shop or such. So one other comment on this. So to go a little bit deeper, there was a survey that came out, and it was in the paper today, actually. And it ties in with my comments about people going back to work in the federal government. The survey found that, and they polled like 2,100 workers, that 69% of people believe that the reason they're not going back to work is because their employer is requiring traditional work kind of expectations around the workplace. And so they started to dig in and say, well, what is it that's what's most important of all the things that you would like to have changed, even if you were to come back at any sort of cadence, what would that be? And this is what shocked me. 72% of the employees surveyed said they want a flexible dress code, and they would be enticed to come into the office more if they could choose to wear clothing of their own styles. And I thought that was like, wow. And so then they went, that Gallup survey then said, okay, well, what are people wearing? Like today, what are people wearing to the office? At 41% of people are required to wear business casual, 31% wear streetwear, and then the other quarter or so wear uniforms. Only 3% of the workforce today is actually wearing a suit to work. That's astonishing relative to when, my parents and my grandparents used to go to the office. But, I'm looking at this going, okay, that's clear evidence of what the pandemic had done to our workforce, where people got to work from home, proverbially speaking, in their pajamas. Not to suggest they were actually in pajamas, but I'm sure in some cases they were. But call me old school. But when you're in the office, I'm a firm believer, even when you're at home, casual dress leads to casual thoughts. And I'm not suggesting we need to be wearing suits to work. I don't wear a suit to work myself. But business casual is okay to be expected, in my opinion. And that's just, some may disagree that you want to wear flip-flops and sweatpants, whatever. But I just thought that was kind of astonishing. Just the other little comment on what people want. Obviously, commute was a big one. And that was the second one behind attire was... I'm spending, on average, the average American apparently spends about $51 a day between food, parking, transportation costs, and they, by and large, want their employers to pay for that.
I don't disagree with you, Owen, except if I was to walk across the bridge here into Cambridge and walk around and see some of the students, which, MIT and Harvard students, some of the most brilliant minds probably of this next generation, many of them are in flip-flops and sweatpants and a hoodie. So it's
my kids are wearing Crocs right now at school. Okay. So I get it. Call me the old guy. I see what my kids wear to school every day, and it's Crocs and those flip-flops. I don't even know what they're called, but I'm clearly out of touch on that kind of stuff. But yeah, I know. So that might be part of it.
But I think just to touch on, the federal government's in a really difficult position, and I don't even have a comment on that, but I will take it back to the local level, the state of Massachusetts. And, I think maybe this is an issue with the federal government. If you go into any city, and I've done work in almost every state, and we go into these cities, the state and city governments are really usually, and especially in tertiary and secondary markets, they're one of the biggest users, if not the biggest users of downtowns. And that's how governments have been able to revitalize downtowns, is to bring their workers there first, right? But you get into these larger cities, and you walk around and you look for like the Class B or Class C building, and you point at it, you're probably pointing at a building that houses city workers, federal workers, or state workers. They are typically in the cheap kind of part of town, the cheapest building, and they don't improve the space. So would you want to go back to work? I mean, if you just sat on a panel on how the quality and the activation of the space, and I'm not putting words in your mouth, but I believe that's what it was about. It really impacts people coming back to the office. The government spaces have been awful, and they continue to be awful. And I will give credit to the state of Massachusetts. They're in the market. They are the third largest tenant in the market today. Currently, they're in some pretty crappy buildings. They're the third largest tenant in the market today, and they're looking at some really high-quality buildings. Based upon what I know their short list is, hopefully they don't just renew in place and cheap out, but they're looking at some really nice buildings to improve the quality of the assets their employees work in, and that would be pretty exciting, one, for them, and two, for the city, to see them move out of these buildings that really should get torn down and turned into residential or something else, and move to more of the core with everybody else. So that's my thought on it.
If any of you have been to D.C., it's hard to miss if you're walking around, the FBI's headquarters. It's one of the pardon me to the FBI, one of the ugliest buildings in downtown Washington, D.C. And, to your point, Brian, they are obviously, if you're going to the office there, you're probably not that inspired. Well, you might have read earlier this month, last month, it would have been November, that they've chosen to move the FBI out of D.C. They're going to Greenbelt, Maryland. It's a vacant lot where they're going to be building a brand new state-of-the-art facility. Great. I think that's wonderful. We all need the FBI. They're certainly a critical part of our national security. They'll still maintain a small presence downtown. But maybe that's what we need to do. Maybe the government needs to follow the path of the FBI and say, we need these people obviously need to be in the office because they're doing critical security work that's for keeping us safe. And so they're following that kind of thesis, Brian, where they're moving out of D.C. and moving to Greenbelt, Maryland. And people were pretty frustrated by that, especially the D.C. mayor and obviously the state of Virginia, which wanted them to come to their own state. But we might see more of that to follow. I don't know. We'll see.
I think I've got a great segue with the FBI moving out of the D.C. into Greenbelt, Maryland. I don't know where Greenbelt, Maryland is. That the name of a city, or is that just a? Yeah, I think that's a perfect segue. I did a little homework over the weekend and played around in CoStar, which is full of data, and I just wanted to see what I found. So I ran a report of availability rates across the country, and there's something like 500 submarkets defined. And I realized that the size of the market matters. I mean, the biggest market is New York City, 979 million square feet of inventory, almost 1 billion square feet of inventory. The smallest market, as defined in CoStar, is Hinesville, Georgia, total market size, 516,000 square feet. Okay, so what happens if we start to slice and dice that data? I organized from largest to smallest and broke it out into 4 tiers. Tier 1, a market that has 100 million square feet or more of total inventory. Tier 2, 20 million to 100 million square feet of total inventory. Tier 3, 5 million to 20 million square feet of inventory. And Tier 4, under 5 million square feet of inventory. So when we group those together, now we look at the average vacancy rate. What do you think is going to happen here? Average vacancy rate, Tier 1, 16%. Not vacancy rate, availability. Average availability rate, Tier 1, 16%. Average availability rate, Tier 2, 10%. Average availability rate, Tier 3, 6.5%. Average availability rate, Tier 4, 5.5%. Okay, super interesting, I think. Is it perhaps the biggest problem is occurring in the biggest markets, and maybe like small town America isn't seeing the same sort of office market upheaval? Maybe. Sarah, my wife, said, no, it's obvious. That's where all the companies in the big cities, that's where all the employees, where they're allowed to work from anywhere, they've moved to those places. I'm not sure if that's it or if it's always been this way. Okay, so I wonder if small town America is immune to so much of what we're talking about in this office upheaval. And here's just a few more ways I sliced and diced the data. The highest availability rate, top 10, they're all from the Tier 1 markets except for one. Stanford, Connecticut is number 9. It's from the Tier 2. Everyone knows it's sort of San Francisco, Houston, Denver, Dallas, Austin. Okay, pause. Interesting to note 3 of the top 5 are in Texas. Continuing on, Washington, D.C., Chicago, San Jose, Stanford, Atlanta, ranging from 26% in San Francisco down to 19% by the time you get to Atlanta. Okay, then one other way to slice and dice the data that came out of this CoStar report was net absorption prior 12 months, which is pretty interesting to look at. Like, are we leasing our way out of this problem yet? Or, because net absorption can also be a negative number, meaning there's an increase to total inventory occurring over the last 12 months, which means we're still plowing into the problem. The problem's getting worse, not better. So best net absorption over the prior 12 months, Houston, close to 900,000 feet of positive net absorption. Harrisburg, PA, Green Bay, Wisconsin, Huntsville, Alabama, they're all around 400,000 or 500,000. Grand Rapids, Michigan, Omaha, Miami, Tulsa, Sioux Falls, and Northwest Arkansas had 330,000 feet of positive net absorption. But then we get down to the other end, and the bottom 10, all negative numbers, from leading up to The worst, unfortunately, San Francisco at negative 9.6 million square feet. But those top 10 are of worst are Philadelphia, East Bay, Bay Area, California, Denver, Washington, D.C., Atlanta, Seattle, L.A., Chicago, New York, San Francisco, ranging from 2.2 million negative square feet of negative absorption in Philadelphia to the 9.6 million I mentioned in San Francisco. So just really interesting to look at the data. My main point being this idea that small town America seems like the availability rate's been pretty consistent, and they're not seeing a big spike like we're seeing in the big cities. So maybe the biggest problem is only occurring in the biggest cities. What do you think?
Yeah, it would be really interesting to go a few layers deeper. I mean, I have some initial gut reactions. I mean, you think about why is availability so low in these sort of small town America cities, and I think it's probably a function of how much inventory has been built over the last 10, 20 years. I mean, the three Texas markets that you're referencing, by most standards from, investors and allocating, capital to Texas, building new products, people would say those are some of the hottest markets in the country over the last 10 years, just because of the sort of like positive momentum that Texas has had as a state during COVID and, attracting high quality businesses to the state and all that, and manufacturing in Mexico, things like that have contributed to Texas doing well. I mean, I think it could just be purely a function of how much new product has been delivered over the last 10 years. And it may be that in small town America, there's basically been no product that's been delivered. I mean, it depends how small town America are we talking. I mean, I think, in your like tier 4 cities, like, not 100% sure how that's defined, but it's possible that includes cities that have 500,000 square feet or 1 million square feet of office space, and that's it. And you start thinking about how much of that 1 million square feet is the, just basic local services, like people supporting the fire department and police department and the, city administration building and things like that. It's like you may remove half the office space just for government, local government purposes. So yeah, I'd be really interested to understand that better. But those are my initial reactions, and not surprised by the data at all. Obviously, small town America also has a lot less exposure to technology companies going and working from home.
I agree with you, Tucker. The other piece that I was thinking about in listening to the statistics is the risk profile of developers in secondary and tertiary markets is very different, right? So I was down in Atlanta touring, and we drove by, I want to say had to be 300 to 500,000 foot spec office buildings under construction with no tenants. So these larger markets like the Dallas or the Houston or the Austin markets saw a massive amount of speculative development. Atlanta, San Francisco, you see these markets that are, the risk profile for developers are very different. They can get their debt financing, they can line up investors, they could sell the dream into these high growth markets. In the middle America, in slower growth markets, you need a anchor tenant or more, right? So you need 50, 60, 70% pre-leasing before you can kick off any development. So there's way less development. There's way less risk in the development pipeline. And it makes a much more stable environment that doesn't have these wide swings through economic cycles or through this COVID cycle that we're in today, is my thought. So interesting, John. Thanks for dicing that up, though. It certainly creates a good conversation around. The other piece I was thinking, a good conversation around people in these major cities are way more disrupted. It costs way more to go to work, right? What is it to take the train from the suburbs of Boston downtown? It's hundreds of dollars a month. If you drive. They're delivering a brand new building here for State Street in a company called InterSystems. State Street's moving in right now, or moved in. InterSystem moves in over the next 12 months. Unreserved parking in the building is $650. Reserved parking, $850. Right. So you're an employee and you're going to be asked to come to work at State Street 5 days a week, and they're going to ask you to pay $650, or you're going to spend $300 or $400 to take the train, depending upon where you come from. You go out and get a salad, it's $20 in big cities, right? It's $20, $25 for lunch with a coffee. So these costs, then you got to go, Owen, you got to go get a suit, or you got to go get business casual versus sitting at home in your pajamas or some activewear that you're wearing to the gym and also, wearing on a Zoom call. You start adding all those costs up in major cities, it's really expensive to work in them. In these smaller cities, you go, it's free parking. You're wearing basically the same clothes you wear on a Saturday to work, because most of those companies are all laid back and more casual. It's just a much less expensive experience to go to work in secondary and tertiary markets, is my thought.
You can still solve for it in the city, though, Brian. There's plenty of places around Seattle where there's office buildings that have free parking. I agree, downtown anywhere USA is expensive to park for the most part. But if you need to be a Seattle tenant, San Francisco, Boston, New York, LA, you can find spaces. Now, granted, you're not going to be in city center. But if you want to afford your people the opportunity to drive to work, not pay for parking, yeah, you may not be downtown, but in my experience, you can get pretty close to downtown and still solve for those things. And I see why that's the second biggest item that people are claiming is resisting them going to work. I mean, if the average cost to go to work every day truly is $51, and that's what people are suggesting based off of transportation costs, food, whatever. I mean, that's a lot of money. It's $1,000 a month or so. It depends on how many days you go to work. So I get it, right? So if that's what your employees are telling you, then maybe it's time to start looking at leaving downtown and being in a tertiary market where people can drive to work for free. This is something to think about.
Okay. Super interesting pod, a range of topics, some healthy debate today. Thanks so much, everyone, for listening to episode 25, and we will be back very soon with episode 26.